Look, we get it. The world of investing can seem about as welcoming as a Wall Street banker at a WeWork happy hour. It's all jargon, algorithms, and guys named Chad bragging about their crypto gains. But here's the thing. You don't need a yacht load of cash to get started. Seriously, even small, consistent investments can grow over time, like a financial chia pet, but hopefully, less disappointing. We're going to break down the basics from figuring out what you want to achieve to navigating the wild world of stocks, bonds, and those things called mutual funds. So buckle up, grab your metaphorical climbing gear, and maybe a snack, because we're about to embark on a journey to financial literacy. Before you even think about throwing your hard-earned cash at the stock market, we got to talk about your goals. What are you saving for? A down payment on a place that isn't the size of a shoebox? Early retirement where you can finally perfect your sourdough recipe? Knowing your goals helps determine your time horizon. Are we talking 5 years, 10, 30? See, long-term goals give your money more time to grow, while short-term goals might require a more conservative approach. Then there's risk tolerance. Are you the type who checks under the bed for monsters before going to sleep? Or are you more of a let's jump out of a plane for fun kind of person? Your risk tolerance dictates how much you're comfortable seeing your investments fluctuate. High risk usually means higher potential rewards, but also a wilder ride. Low risk is more like a leisurely stroll through Central Park. Less exciting, but you're less likely to get mugged. The key takeaway here is, there's no right or wrong answer. It's about finding what aligns with your individual goals and your ability to stomach those inevitable market ups and downs. Think of it like choosing a roller coaster. Some people live for the adrenaline rush of a triple loop-de-loop, while others prefer the gentle sway of the Ferris wheel. Both are valid choices, just like your investment strategy. So take some time to really think about what you want to achieve and how much risk you can handle. Alright, so you've got your goals and risk tolerance figured out. Now let's talk about where you can actually put your money. Because, surprise, it's not just about picking random letters on the stock market like a financial chimpanzee. First up, we've got stocks. Little pieces of ownership in publicly traded companies. Think of it like buying a brick in a giant Lego castle. The bigger and more successful the castle, the more valuable your brick becomes. Then there are bonds, which are essentially IOUs issued by governments or companies. They're generally less risky than stocks, but also offer lower potential returns. Think of them as the reliable but slightly boring friend in your investment portfolio. Next, we've got mutual funds and ETFs, which are like baskets of stocks or bonds managed by professionals. They offer instant diversification, which we'll talk more about later, but they also come with fees. And of course, there's real estate, everyone's favorite Monopoly game piece. While it can be lucrative, it's also illiquid, meaning it can be difficult to sell quickly if you need your money fast. These are just a few examples, and there are plenty of other more exotic options out there, like cryptocurrencies and NFTs. But remember, just because something is trendy doesn't mean it's a good investment. The important thing is to diversify your portfolio and invest in things that align with your goals, risk tolerance, and, your actual understanding of what they are. All right, folks, time for the most exciting part of this whole investing shebang: compound interest. It's like the financial equivalent of finding a $20 bill in your old jeans, except way more lucrative. In simple terms, compound interest is interest earned on interest. It's like your money is having babies, and then those babies have babies, and suddenly you've got a whole financial family growing exponentially. Here's an example. Let's say you invest $1,000 with an annual return of 7%. After 1 year, you'd have $1,070. Not bad, right? But here's where the magic happens. In year 2, you're earning interest on $1,070, not just your original $1,000, and so on and so forth. Over time, this snowball effect can lead to significant growth. The earlier you start, the more time your money has to compound, and the less you actually need to invest to reach your goals. Think of it like this. If you invest $100 a month starting at age 25 with a 7% return, you'd have over $1 million by the time you're 65. $1 million, just from consistently investing a little bit each month. So start small, start now, and let the magic of compound interest work its wonders. Your future self will thank you for it. Okay, let's talk about diversification. It's a fancy word that basically means not putting all your eggs in one basket. Because if that basket drops, well, you're left with a whole lot of scrambled financial dreams. Diversifying your portfolio means spreading your investments across different asset classes, like stocks, bonds, real estate, and maybe even a little bit of that weird cryptocurrency your nephew keeps rambling about. The idea is that if one asset class takes a hit, the others can help cushion the blow. It's like having a financial safety net. There are different approaches to diversification. You can diversify across asset classes, sectors, geographies, and even investment strategies. The key is to find a balance that aligns with your risk tolerance and goals. And remember, diversification isn't a one-time thing. You need to regularly rebalance your portfolio to make sure you're still on track. Think of it like maintaining a healthy diet. You wouldn't just eat pizza every day, right? Well, maybe some of you would, but you get the point. A balanced portfolio, just like a balanced diet, is key to long-term financial health. So, don't put all your financial eggs in one basket, unless that basket is made of adamantium and guarded by a team of highly trained ninjas. All right, folks, let's talk about research. Because blindly throwing money at the stock market is about as effective as playing darts with your eyes closed. You might get lucky once in a while, but you're more likely to end up with a hole in the wall and a bruised ego. Now, I know what you're thinking. Research? But that sounds boring. And you're not entirely wrong. It's not exactly binge watching your favorite show or scrolling through endless TikToks, but it's crucial to making informed investment decisions. Think of it like this. You wouldn't buy a car without looking under the hood, kicking the tires, and taking it for a test drive, right? Well, investing your money deserves the same level of due diligence. Start by understanding the basics of different investment options. Read books, articles, reputable financial websites. There's a wealth of information out there, and much of it is free. Don't be afraid to ask questions. Talk to financial advisors, consult with professionals, or even have a chat with that friend who always seems to have their financial act together. So ditch the dartboard, put on your metaphorical detective hat, and start investigating. All right, let's be real for a second. Not everyone has the time or the inclination to become a financial whiz, and that's okay. Thankfully, we live in an age where technology can do a lot of the heavy lifting for us, like ordering takeout or finding a date online, and yes, even investing. Enter robo-advisors and investment apps. These digital platforms use fancy algorithms and artificial intelligence to manage your investments based on your goals, risk tolerance, and other factors you input. Think of them like your own personal financial advisor, but without the expensive suits and the awkward small talk about the weather. They're generally more affordable than traditional financial advisors and accessible to investors of all levels. Plus, they take the emotion out of investing. Because let's be honest, we've all been tempted to make impulsive financial decisions based on fear or greed. Robo-advisors and investment apps remove those emotional biases and stick to the plan no matter what the market is doing. Do your research, compare fees, features, and investment strategies before choosing one that aligns with your needs. But if you're looking for an easy, affordable, and relatively hands-off approach to investing, robo-advisors and investment apps might just be your new best friend. Listen, we get it. You see those headlines about people getting rich quick off the latest meme stock or cryptocurrency, and you think, why not me? I deserve a Lamborghini too. But here's the thing. Investing is not a get-rich-quick scheme. It's a marathon, not a sprint. It's about slow, steady growth over time. It's about riding out the inevitable market fluctuations and sticking to your plan. It's about delaying gratification and making choices that benefit your future self, even if it means sacrificing a little bit of instant gratification today. Think of it like growing a tree. You plant a seed, you water it, you nurture it, and you patiently wait for it to grow. You don't dig it up every other week to see if it's sprouted roots yet. That's just crazy, and you'll probably kill the tree. The same goes for your investments. You have to give them time to grow. Don't panic sell at the first sign of a market downturn. Don't constantly chase the latest hot stock tip. Just stay the course, be patient, and let compound interest work its magic. Remember, Rome wasn't built in a day, and neither is a solid financial future. So, there you have it. The basics of investing, broken down in a way that even your Uncle Sal, who still thinks Bitcoin is some kind of fancy bird, can understand. Remember, investing doesn't have to be intimidating. By setting clear goals, understanding your risk tolerance, and diversifying your investments, you can set yourself up for a brighter financial future. And hey, if you're hungry for more investing wisdom, be sure to check out my next video where we'll delve into more advanced strategies like picking individual stocks, short selling, and maybe even dabbling in those weird NFT things. Until next time, stay informed, stay invested, and most importantly, stay fabulous.